Greetings from Sentara Capital. I am Will Allen. One of the questions that we recently have been receiving from clients revolves around the significance of the downward revision to the first quarter GDP report. Now, GDP measures economic growth, and in the first quarter, the U.S. economy actually contracted at a 1% annualized rate. Now, this obviously raised some eyebrows, and part of the contraction was due definitely to the bad weather we had in the U.S. this winter. That certainly was a damper on economic growth. However, there is a trend that has been going on the last 3 or 4 years that we wanted to point out. And if you take a look at this chart we have here for you, what this shows is economic analysts' expectations for U.S. GDP growth and how that changes over time. And so this shows 2011, 12, 13, and now 2014. And what you will notice here is that analysts have tended to overestimate what economic growth is going to be, and as time goes on, they have had to downgrade those expectations, and its growth has not met their previous estimates. Now, this is a problem because in the long run, the U.S. economy needs strong economic growth for more jobs to be created, for higher paying jobs to be created, and for the stock market to move higher. Now, the last few years the stock market's done well despite sluggish growth, and a big reason for that has been the involvement of the Federal Reserve. They've kept interest rates down near zero for about 5 years now, and they also have implemented their bond buying programs. Now, going forward, they are in the process of tapering or removing the bond buying programs right now, and eventually they're going to have to raise interest rates. And so it's going to be important that economic growth picks up. Now, in past recessions, we have seen coming out of those recessions economic growth of 3, 4, and sometimes even 5%. And that has been good. That has helped propel the economy. That's helped the stock market recover from recession losses. So far this recovery, we haven't seen those growth rates, but we will be watching closely for indicators from the economy and recent data release that can let us know that maybe the economy is picking up steam and recovering to 3%, 4% rates of return. One point I want to make, the stock market can do well in spite of sluggish growth when valuations are cheap. But we certainly can't say that valuations are cheap here in the U.S. any longer after the rally we've had the last few years. But as always, we'll keep a close eye on this, and thanks for watching.